What's driving markets? Welcome to Market Take. Each week, we'll bring you our insights on the latest market and economic trends that are impacting investments. I'm your host, Wei Li, Global Chief Investment Strategist at BlackRock. There's a huge amount of policy uncertainty right now. In fact, it has been impossible to predict policy. We find it more rewarding to establish guardrails, to try to understand what could potentially prompt the administration to potentially change the course of policy making. It seems to take some account of market volatility, financial risks, and pushbacks from other sources, as well as a country's willingness to engage. We think that can put a check on its maximal stance, and we also think that eases the risks of a near-term financial accident. We have been saying that in the near term, because of policy uncertainty, risk assets were likely going to come under pressure. And over the longer term, fundamentals should prevail and were more positive over the 6 to 12 month horizon. After April the 2nd, huge amount of policy uncertainty aside, what really worried us was that there didn't seem to be checks on the maximal policy making stance from the US administration, which made us think that we couldn't really see that much further ahead, and we shortened the tactical investment horizon from 6 to 12 months to 3 months, putting more emphasis on the near-term hunkering down. And at the time, we said that we didn't know how long or how short this period would be. Then forward to last week, where my biggest takeaway is that there were checks after all on the maximal policy making stance from the US administration. And yes, of course, looking ahead, there is going to be so much uncertainty, volatility, policy headlines flying around. But the fact that the checks exist gave us confidence to resume the 6 to 12 month horizon of tactical investing, where we are more positive. Currently, we're modestly positive on US equities, especially after the year-to-date drawdown, and we're modestly positive on Japanese equities on a currency unhedged basis. We're selectively in favor of sector opportunities like banks in Europe. We are underweight long-duration US treasuries. They are supposed to behave like safe haven assets, and they really haven't been in this new regime of high debt and inflationary pressure. And in fact, gold has been a better diversifier in this new environment for portfolios. For more details, read our weekly market commentary. Go to www.blackrock.com/weekly-commentary. Thank you for tuning in. If you have enjoyed this episode, subscribe to Market Take wherever you get your podcast.
This material is intended for informational purposes only and does not constitute investment advice, a recommendation, or an offer or solicitation to purchase or sell any securities, funds, or strategies to any person in any jurisdiction in which an offer, solicitation, purchase, or sale would be unlawful under the securities laws of such jurisdiction. The opinions expressed are as of the date of publication and are subject to change without notice. Reliance upon information in this material is at the sole discretion of the listener. Investing involves risks. BlackRock does and may seek to do business with companies covered in this podcast. As a result, listeners should be aware that the firm may have a conflict of interest that could affect the objectivity of this podcast. For more information, visit blackrock.com.